And I would say, Tom, the paradigm shift here is twofold. The first paradigm shift is for the first time in 30 years, people in the Western world are living in environments where the currency is weakening more than 7% a year. It's weakening at 15 to 20% a year. That's the first paradigm shift, because that changes how you discount bonds, how you discount value stocks, how you discount commercial real estate, and you got to think different. And the second paradigm shift is Bitcoin's the first digital monetary network in the history of the human race. We never in 5,000 years could make money work on a computer network. And it wasn't clear it was going to work when it was $1 billion. But by the time we got to June, it was $200 billion. And, you guys follow digital networks, Facebook, Amazon, Apple, Google. Every good idea for the past decade has been a digital network. And when they get to 200 billion in market cap, they're pretty hard to stop. So our conclusion was, this is like Facebook for money or YouTube for money. And we jumped on it. Today, it's $1 trillion digital network. It's the fastest growth to $1 trillion of any network in the history of the world. It took 12 years. Google took 22 years. Amazon took 24 years. Apple took 42 years. Microsoft took 44 years. Those are the only firms that have ever done it. Bitcoin has done it. And so the paradigm shift is digital monetary network, a solution to everybody's problem, and COVID lockdowns, everybody's got a problem. You put those two things together, you have to think different. And that's why we did what we did. Right now, I think it's $1 trillion dominant network that's 100 times bigger than the next best thing like it. It's about as likely that Bitcoin disappears as it is that Google disappears in 36 months.
What are your projections, or what is your overall perspective on, let's say, Bitcoin anywhere 5 to 10 years out in terms of the, and I assume you fully anticipate holding your position and or adding to it here over the next 5 to 10 years?
My view is Bitcoin is the apex property of the human race, which means that it's the last thing you will sell. If you had a block of Manhattan, you would hold it a long time because you thought Manhattan's always going to be valuable, but Bitcoin's better than Manhattan. And so it's the ultimate long duration asset, or in other words, an institutional grade treasury reserve asset. You ought to buy it and hold it. And if you ever need cash, just borrow against it, just finance it. The native yield of Bitcoin's been 200% a year for a decade. You could borrow money and pay 5 or 10% interest and borrow infinitely forever and have your debt to equity ratio fall, right? As long as that trend continues. And it's continued for 10 years until this year when it went to 400% appreciation. And that's because Bitcoin's a fire in cyberspace, a monetary fire. How do you feed a monetary fire? With money. And what happened this year? Well, two things. The cost of holding US dollars tripled. And so that's the macroeconomic driver. And the other thing that happened is that Bitcoin burned into the public markets. And look at companies like mine. We went to the market, we borrowed $1 billion at 0% interest. So we bought Bitcoin yielding more than 200% interest. How many times would you actually trade $1 billion at zero for 200% yield? When do you think I got to stop that?
Well, what do you think will play out in terms of the level of volatility of Bitcoin's price?
It's falling already. I think the people that lived the last decade, the first decade of Bitcoin, have been scarred by their experiences because they had a very volatile first decade. But I think that those are misleading because the system has evolved. Institutions have come into the marketplace. And since March of 2020, it's a totally different asset class. If you look at the chart since March, it goes up 50%, down 25%, up 50, retraces 20, up 60, retraces 25, 30, up 50, retraces 25. And so it's actually simply growing from 4,000 to 60,000. The way I explain it to people is if you studied LeBron James's career from age 9 to 18, he was talented but volatile. But it would be a mistake to extrapolate from the first 9 years or first 10 years to the next 10 years. From age 18 to age 28, LeBron James was the greatest athlete in the sport and not volatile at all, not volatile except in a good way. If you're staring at a basketball court, watching stuff move, he's actually making everything happen. He's the volatile game maker that's destroying everybody, but it's not a bad volatility. The bad volatility, you want to get rid of volatility, put a lump of rocks on the basketball court, you have no volatility. So I'm not terribly concerned with the volatility. I think there'll be accelerations and pullbacks, but the institutions are collaring it on both sides. The capital is not consumer leverage capital, day traders. The capital right now is insurance companies, big public companies. We're coming in to buy it forever. We're not like, ask me when I'm going to sell it. Never. I'm not going to sell it ever. And so the narrative has rotated. Long-term institutional deep pockets, and the asset class has matured. And of course, the law of large numbers say a $1 trillion entity has more inertia to it than a $100 billion entity. And what do I expect to happen? I expect it will grow aggressively toward gold, and it will flip gold, and then it will demonetize gold and subsume gold. And probably it'll be first $10 trillion and gold is 10 trillion. Then it'll be 20 trillion and gold will be 5 trillion or 4. And gold will eventually become an ornamental metal. Bitcoin is going to suck the monetary energy off of negative yielding bonds. Tom, I ran a survey on my Twitter. I got 65,000 responses 2 days ago. I asked people, where did the money come from you used to buy Bitcoin? 49% is stocks, 20% is gold, 10% is bonds, 19% is property. Basically, stocks are going to be negative yielding if you're value stocks because they can't keep up with the rate of monetary expansion. Everybody knows bonds are destroyed. Ray Dalio just told the world they're all negative yielding. By the way, he thinks they're negative yielding versus CPI. The real point is they're negative yielding versus the cost of capital or the rate of the monetary supply expansion, which is like 15 to 25% a year. They're screaming value destroyers. So I think that Bitcoin goes to 10 trillion and it goes as fast as it can. And then it grows 50, 60% a year toward 100 trillion. And it slows down from 200 to 150 to 100 to 80 to 60 to 40. You know, you saw Google and Amazon growing at 20% a year off of large numbers consistently for the past 5 years. I think when it gets that big, it'll be growing 20% a year. And eventually it'll subsume the total addressable market for treasury assets. And then it will be growing at an organic rate, 5, 6, 7%, a fair cost of capital. So Bitcoin is probably the most environmentally friendly thing we have on this earth, right? It's literally 1% energy intensity, and it's going toward 0.1% energy intensity. Because once you get to 10 trillion to $20 trillion of assets on the network, you've got a value and use of 2 trillion a year against what? 4 billion in energy? We never came up with a better use of energy than store all the world's money, right? That's pretty good use. You know, for a decade, from 2010 to 2020, the money supply in the US and Europe expanded by about 6% a year. Treasury strategies yielded about 3% a year. You had a negative real yield of about 3%. In March of 2020, we had this K-shaped recovery, the pandemic, the response. Cost of capital tripled from 8% to 24% because the Fed started printing money. The Treasury yields went to zero, flatlined, and our expectation is they're flatlined for 4 years now. Jerome Powell just said it yesterday. He said it every time he got on TV. The negative real yield on a conventional Treasury strategy now goes to minus 24%. And now if you figure that maybe we'll do better and we'll only inflate the money supply by 15% a year for the next 8 years, minus 15% negative real yield. So the money is melting as a store of value at 15% to 20% a year. That's the melting ice cube. And that's what we got slammed in the face with after March. By June, we figured that this wasn't going away. And we also realized we weren't going to use the cash or need the cash to run the business. And so we had to figure out, what are we going to do? Because in essence, if the cost of capital is 24%, and that's, by the way, what you could have got by leaving your money in S&P and doing nothing for the year. If the cost of capital goes to 24%, then you really have a fiduciary obligation to either recoup the 24% or give it to an investor who can get the 24% doing something that they can do. So that's the major catalytic event that caused us to drive toward the August 11th decision.
So some have described Bitcoin as a check or an evaluation of government spending around the world. So why would governments allow that to happen? What do you see as the risk on the regulatory side?
Well, the most important thing to know is that although people call it a cryptocurrency, It's not, it's crypto asset. Money has two flavors. It's got the medium of exchange currency element, and it's got the store of value asset element. Bitcoin is a great store of value, digital gold. What's the addressable market? 100 to 200 trillion dollars. Half of all the stuff that floats around the system is store of value. People just want to keep their money forever. The other aspect of currency is I want to buy a cup of coffee 1 billion times a day. People are going to do that with dollars and won and yen and euros and Chinese currency. They're going to do it on Apple Pay and Visa and MasterCard and Square and every other, and Ant and every other regulated payment rail. The government, as long as it functions in China, the US, or Europe, is going to control the currency. And they've given it tax treatment. When I give you $1 million or 100,000 and you give it back to me a year later, there's no capital gain tax on it. It's not a taxable event. It makes sense to use dollars as currency. On the other hand, Bitcoin is property. It's been legitimized as property by the IRS, by the SEC, by the OCC. It's not going away. It's not going to be currency in the US. It's not fast enough, and the tax treatment is hostile. It is going to be property. And to the extent that people buy it from regulated custodians subject to AML KYC regulations, and banks like Morgan Stanley, where they're buying it now, or from players like Fidelity, the government's just going to make sure that it has the same AML KYC regs and clarity that gold or silver or stocks or bonds or any other derivative instrument would have. It's not threatening to a government if I'm swapping out my gold for Bitcoin. It's threatening to the government if you can move $1 billion to a private wallet in sub-Saharan Africa without KYC AML. So you can expect that they'll have regs around the latter, and that's totally fine. And as they clarify those even more, it's just going to be bullish for the asset class, because that's the green light for every insurance company and endowment to buy 100x more than they bought so far.